Hello and welcome. And we're here at Holistic Investments, and I'm your host, Konstantin Kogan. It is my pleasure to have Tyler Ward today, co-founder of BarnBridge. Hi, Tyler.
Hey, Konstantin. How are you doing?
Amazing. It's a great beginning of the year. As we speak, Bitcoin is 35K today. So could be more grateful for such a beginning of the year. But today we're going to speak more about your incredible projects. And before that, traditionally I have to throw a disclaimer. So this content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or any other advice. So now we're off the hook. Let's talk about BarnBridge. I mean, I stumbled upon your project before, and then in a previous interview with Keegan and EJ from Fourth Revolution Capital, I was really excited how they showed me, your platform. So obviously, there are investors in the platform, so they kind of biased, So you're the founder, so I understand you're also biased in a way, but I want to make sure that right now, because after the interview would happen, a lot of my friends who are into DeFi, they really loved, and they want to get more and more into depth what you guys are doing.
Yep.
Because it's not an easy conversation we're going to talk about. Your platform is tokenizing the risk, and it's a lot of more fintechy terms, close to collateralized debt obligations and generally the more fixed income instruments. So I want to make sure we make a digestible content. So let's start from simple things. How would you describe what BarnBridge is doing in a simplified fashion?
Yeah, I think you got it right a second ago. The easiest way to put it would be that we're trying to tokenize risk, where you have a ton of, when I'm defining risk, I'm talking about the risk that what you're holding will increase or decrease in value, because people view, they hear risk and think that it's a negative term, but from a financial perspective, risk also represents the upside. So risk reward is synonymous with when you say risk in finance. So a riskier asset doesn't necessarily mean a worse asset. It just means that it has a higher probability to fluctuate in value in either direction. So it's not it's not meant to be a dirty word when it comes to finance. It's just meant to be a red flag word to let you know, hey, you can lose some of your capital. And so with crypto, everything is deemed as risky, but there's there is no such thing as AAA rated debt in crypto. Everything is pretty much considered junk to a traditional investor. And there's other types of risks. There's smart contract risk, which is the reason that it's considered junk, is the risk that the money in crypto is held by smart contracts. Well, those smart contracts, in some ways, people would say that they're safer because they're not at the behest of humans, which can kind of do what they want. And that's a big reason crypto exists. But there's risk that the smart contract underlying could be hacked, right? And so that's not really what I'm talking about when I'm talking about risk. I'm more talking about financial risk, the ability to trade in and out of positions that represent your risk that is in a pool of assets or a pool of yield that's coming in. And we could tokenize smart contract risk, but that's probably a story for another day. When you get to the essence of what tokenized risk is, you're still talking about tokenizing the risk of loss of capital due to a smart contract hack, which could be measured in a monetary amount that would be in an insurance contract. So insurance in DeFi is actually tokenizing the risk of smart contract risk. Well, if you put that into a tokenized risk protocol, you can then build groupings of that risk, right? So we may get into that this idea kind of spirals or kind of splices out into a whole bunch of different ideas, but that's really the easiest way you can think about it is if your audience understands something like an oracle where you can verify something on chain, BarnBridge is very much like a use case of, I mean, somewhat oracles, but smart contracts especially, and that anything that can be measured from a fluctuation perspective can be put into a pool. The pool is powered by smart contracts. And then out of that pool, you create two new representations of the risk in the pool, and how those can behave doesn't have to be one-to-one, right? One can be deemed as riskier and then less risky.
So my question to you probably in the beginning, let's try to go one by one, So when we're talking about the asset fluctuation, right now in a traditional finance, you would talk about the future value of cash flows, right? And in our DeFi world, generally, there's no cash flow in Bitcoin, right? And not that a lot of crypto assets have even the ability to show the fluctuation of the and the cash flow. So how do you manage risk, against the volatility and making sure that, you have a more conservative product, I would say. And that's how can you explain how do you even structure this risk, and what do you mean by actually tokenizing the risk?
Yep, that's a great question. So there's two ways that an asset can fluctuate in value. To what your point was with what they taught us in finance school was a current asset's value is the future value of cash flows. And Bitcoin isn't a productive asset, meaning it doesn't cash flow on its own. It's more like gold, that it behaves as if it's a commodity. But commodities don't fluctuate in a year the way that crypto assets do. I mean, Ethereum's at $1,100 right now, but it was at $80 7 months or in March of last year.
Yeah.
And so I wrote the white paper, the initial framework of the white paper for BarnBridge in April of 2019. And
you've launched where? You launched in July somewhere, right?
Yeah, of 2020. So a year and a half later.
Mm-hmm.
And I needed some of the primitives to come into existence in the ecosystem for something like BarnBridge to be possible. But at a really high level, the two most obvious types of risks that you would want to tokenize is you would either want to tokenize a yield stream that's coming in. So rent in an area fluctuates the housing. If rent goes down, how the market prices of a house would go down in a market, right? If dividends go down, the stock is dropping, right? Interest rates are controlled at the federal level. So if interest rates drop, bonds actually go up in value, but that's because new issuance bonds will come in at a higher interest rate, meaning your cost of new capital. So if you bought a bond at a 1% interest rate, then the federal government raises interest rates to 2%. Well, your $100, if you had the fresh $100, 10 minutes after that happened, you're now making twice as much money, which means the existing $100 that are earning 1%, they go down in value, right? To make up for that difference. So it's pretty much the same everywhere, that it is true that the yield streams will affect the underlying value of products. And actually, even in DeFi this year, one of the reasons that Bitcoin has gone so much up in value, as much as Bitcoin maximalists don't want to admit it, is that ETH has allowed Bitcoin to be tokenized on Ethereum, and then you can borrow against that and then go make money off your Bitcoin. So you've seen it even there, right? Where the reason for the run up in asset prices of even non-productive assets has obviously it's hitting all-time highs, right? Yeah. But within crypto, there's also just what are called alpha fluctuations. So what alpha is when you have just ignore yield in this scenario or any type of money coming in. If I buy a house for $100,000 and I sell a house for $200,000, I have $100,000 of positive alpha. If I sell it for $50,000, I have $50,000 of negative alpha. But,
just like excess return in a nutshell.
Yep. And return's one of those things that is the same as risk in finance, that it can also, like, your return can be negative, right? So normally alpha, you talk about it as like a percentage, but it's at the end of the day, it's a dollar amount. So everything in DeFi is pools of money. I mean, for the most part, like, we talk about decentralized finance, and it's really a bunch of different pools of money that have smart contracts that are programmed to make that pool of money behave a certain way, which is a huge, huge benefit of Ethereum, is that you can write if-then statements into money. So you basically have a pool of money and you say, if this happens, then this happens, right? And that is, at the end of the day, my opinion, the number one like use case of crypto, or one of the most like powerful things about it, is that you can write if-then statements into money. If you talk to like Vitalik, I mean, it's about governance. You can write if-then statements into governance, which can affect, like, you know, everything from voting to media to censorship, all sorts of different things. But we'll just focus on money for the sake of this conversation. If you can write if-then statements into money, there's another thing that when I originally started BarnBridge, I called them risk ramps or risk tranches. But Joel Montenegro, who's a big VC in the space, or like one of the first movers from the old VC world, he wrote about a concept called proof of liquidity, which I wish it had existed when I had first written about BarnBridge, because it's more eloquent. But basically, a proof of liquidity is a tokenized representation of your liquidity in a pool somewhere. So like if you put your money into Uniswap, you get back a proof of liquidity representing your liquidity position inside of Uniswap that you can then go put somewhere else or prove to someone that you've provided liquidity, which, like, that's what you do on synthetics with like the Curve LP tokens. And we'll get to that later when we get into BarnBridge. But what I was interested in from a proof of liquidity perspective, because back when I wrote the white paper for BarnBridge, Uniswap had just launched. Like, they had like $3 million of trades, and I went and listened to Hayden speak at in New York at this thing that ConsenSys put on called, I don't remember the name of it, but I remember that, like, I was in a room of all these like JP Morgan bankers, and everybody was like falling asleep because they didn't know what an automated market maker was. And like me, my mind's like blown thinking about all the technology that you can build off this as a crypto head. And around that time, like, MakerDAO just hit like $100 million of TVL. And so kind of same thing, like, you've got $100 million that just moved into this pool. It took MakerDAO like 7 months to get there. It took LendingTree 7 years to get there. I'm looking at this $3 million of trades that happened on Uniswap, and I'm thinking, well, man, if you can basically take those pools of money and then have a representation of your risk position in it, you can not only break out those risk positions into high and low risk positions, but those are now tradable assets. So like when you have that Uniswap LP token, people don't normally trade those things. There's not like an aftermarket of liquidity. But if you had an Ethereum like alpha volatility position, meaning like the percentage chance that Ethereum's going to fluctuate in value, or your share of that fluctuation, if it does fluctuate in value, that gets really interesting. And that is something that you can't do without smart contract technology, is to have a verifiable and permissionless proof that you like have access to something that has another side. So just to dumb this down and simplify it for everybody, the easiest way to think about this is you've got $100 of ETH. I mean, think these liquidity pools are way bigger, like $100 million of ETH is in a pool, but your $100 representation of it can be split out into two $50 representations, right? So one $50 representation represents 70% of the upside and downside. one represents 30% of the upside and downside. So if it goes to 110, this riskier hand gets 107, less risky hand, 57, less risky hand gets 53. But if it drops, this hand only ends up with 47. This hand ends up with the larger loss, right? So when you start to think about all of the different things that you could tokenize to represent risk, these proofs of liquidity or these proofs of risk are going to have aftermarket value in the way that they perform, because it's a lot easier to buy something that has a designated value somewhere else, and you can value that on chain and see exactly what it's worth. So you can basically create an aftermarket for essentially any position in the world. So the probability that anything would change in value, assuming infinite liquidity, you can structure infinite products with this concept of tokenized risk.
So maybe I'll do another attempt to also add to what you were saying, because I think it's an amazing explanation. But what you're doing with your smart alpha product, like if we do like the opposites, we would go from the opposite conjunction with smart beta, right? So what you're doing there, like you're de-risking the volatility and systematic market risk. So in your case, like you're also, so to speak, like you're removing the risk of not only of the volatility and a potential loss, but also of you also help people to fix a certain gain potential rewards, so that they will not have this this roller coaster, right? As right now, even if you are using, although whatever the Aave, Synthetics, and the Compound, the Uniswap, whatever the platforms you're using, right now there is no fixed rate. All of them are variable, right? So I will not even know what's happening to to the performance of my investment. So what you are trying to do, you're trying to basically create more or less like a conservative product, and create like a fixed income product. If I would to really also put it in other terms, can we position it from this angle?
Yeah, so there's two products. The smart alpha product just represents the alpha fluctuations. I haven't really thought that much about a smart beta product. I mean, I did tweet the other day that someone should make a crypto VIX, and I feel like you could do that pretty easily with oracles. But I think the beta aspect of smart alpha could almost be inherently baked in, where you have to have a pair to the asset to peg it against. So like in my example, I use ETH USDC, like a US dollar. So we'd have to peg it to like USDC.
And also the reason why it is important, like USDC, because it's a stable coin, right? It's just 1-to-1 to dollar. For someone who's not familiar with it, if you peg it to more volatile asset, then it creates an additional complexity, right?
If you wanted to tranche out the risk of beta fluctuating, what you could do is you could take a DeFi asset that's inside of the DPI, which is the DeFi price index, or the DeFi pulse index, which is I think it's the largest index of DeFi protocols or assets that represent the governance tokens of the protocols. So if you wanted to create a smart beta product, what you could, and I know this is getting off on a tangent, I just think it's cool. You could take something that's in the DPI like Synthetics, and instead of pegging it from making the pair Synthetics USDC, you could make it Synthetics DPI, and that would actually, if the beta was 1-to-1, there would be no loss. But if the beta fluctuated, then you can structure out the risk. So you could actually use the smart alpha product to create a smart beta product, assuming the indexes were accurate. And that's actually probably a clever idea, to make like an inverse of the DPI, where I could say, I think that, so what you're doing in that scenario is betting that Synthetics is going to outperform or underperform the rest of DeFi. And that's a pretty, that's a clever idea. I like it. But the smart yield concept is on the other side. So smart alpha, going back, Bitcoin isn't productive. It doesn't have a cash flow. So you're just betting on the price volatility, like underlying market price volatility. You also can take the concept and apply it to yield. And again, it's the same concept that there's a pool of money that is bringing in yield. And so if you put $100 into Aave for 100 DAI into Aave, I would assume that the 30-day interest rate on Aave for DAI is probably around 5%. So what you can say is if I put this $100 straight in, then I'm going to most likely make 5%. But the fact that nothing in crypto, there isn't massive use cases for fixed income. It's more variable annuities. Like, so when the fact that I can't tell you what the exact rate is that I'm going to make tomorrow shows that it's not a fixed income, it's a variable income.
Yeah.
And so when you get into financial planning, and there's two reasons that fixed income is the most traded asset in the world, both in like volume and then like the money made. Like when everybody talks about Wall Street, they're talking about bonds, right? Like equities are in Dallas, so the way that they say it on like at Goldman Sachs, right? So basically there's two reasons for that. One is there's a maturity. So like an equity, I can like buy Ethereum or I can buy Tesla, right? And hold it for 50 years. And that Wall Street trader only made one transaction 50 years ago off of me. But fixed income has maturities, meaning like if you have a forward 5% coupon that's AAA rated in a year, however many years at maturity, it's essentially going to mature and you have to buy more, right? You normally go back and buy it from the same guy that you bought it from the first time. With the interest rate fluctuations, there's a lot more trading that happens with it. But that's like in theory why fixed income has more trading volume than an equity does, just because there's more of a need caused by the maturities. The other reason that it's become extremely popular is because of financial planning. So if you can know that there's an amount of money coming in on a bond and your company owns X amount of this other company's bonds, then you know that there's a guaranteed cash stream coming in that can pay for like salaries, XYZ, so that then you can say like, all right, I'm going to go like get risky with this money because I know that like our, money's like, that's what financial planning is essentially lining up cash flows to ensure that you don't miss payments and get into bad creditworthiness. So with that said, there isn't fixed income yet in crypto. I think that it's coming, but the general concept around BarnBridge, I think originally started out more as the alpha fluctuations. But what I realized is that you could essentially take just thinking about how risk behaves in a pool and having a lower risk and higher risk tranche, you can essentially take a variable annuity and pull it into an income stream and say, look, this has been 5% for 30 days, put $100 in, now you've got two $50 representations of it. What you would then say is like, hey, riskier side guarantees the lower risk side a 2.5% rate, right? And they're if it drops down to 2.5%, then the riskier side doesn't make any money. They just start net, right? But if it goes up to 10%, then the lower risk side is basically said, well, I don't really care about if this goes up in value. I just want to lock in a fixed income stream. So that's a way that you can essentially use tokenized risk to create a fixed income stream and then a more variable income stream on the other side of the equation. But just to really hammer in what tokenized risk is and thinking about income streams, if you took a fixed income stream then and put it into that same product, you can still change the way that the smart contract behaves by saying this fixed, the lower risk fixed side gets first payout, the higher risk gets second payout, but it's a higher payout, right? So I may basically say, okay, now I have a fixed income stream that is tokenized out. Well, this side gets paid out first of that 5%, but they only get 2% of it. This side takes 3% of it, meaning I mean, you'd have to do the backwards math of what your $50 of $100, it'd be, this side would make 6%, this side would make less than 2%, right?
Mm-hmm.
Assuming the whole thing gets paid back. But normally when something gets paid back, it doesn't default in like the first couple payments, it defaults later. So that's how you could use, just thinking about BarnBridge as tokenized risks representing a larger pool of money. How that money behaves is all written into the smart contract. Does that, I kind of got into the weeds there, but
no, I think that is interesting. So let's go. I mean, there are a lot of ways, how to look at it. And again, for some folks who want to get more into depth, like, what are the other risks? For example, you can watch like The Big Short, right? That describes the subprime mortgage crises with all those CDOs, like collateral debt obligations, and how like the madness of how Wall Street actually were packaging like, some junk, like debt, and making sure that institutional investors invest billions of dollars into it, right? And then it blew up, and they knew that it would blow up. And the problem is that who actually bared all those losses? Like not a single bank, though. This actually went to bailout, like to simple taxpayers, right? And what is crazy here, that is, we're talking about billions and billions, and now probably essentially right now we're talking about trillions of dollars, right? Which, to me, if you think about it, not only economically but philosophically, like creating like slaves from people. Because right now there is one economist who calculated roughly that every child born to this, like in 2020, 2021, is actually a debt slave for 180 following years, just because of what we're having with economy, right? So I think what we're having with the decentralized version of it, how the transparency that we're providing, I mean, I'm not a dreamer. I also understand the certain other risks, right? But this is a potential to actually create a better version of this idea, which is, in its essence, it's not bad. It's just a more complex synthetic instrument, like, of packaging debt. If we want to really simplify it, we're talking about here like bonds, loans, like floating rate notes, and you can package it in a very transparent form. But the problem is, like, banks and financiers of this world, they don't want like the retail investors to understand it. Like you should read probably 200 pages of prospectus to even like start like understanding what are we even talking about. And moreover, what I would say to your point, which is interesting, that right now the rates are not the same. That the rates are not that attractive, and the risk is actually also like, it's pretty high. It's backed by the government. That's why we're still like having this layer of protection. But again, those are the questions which we can discuss like probably for hours. This is systematic problems, in the world. What I want to get into is like, let's talk about the practicality. If you can maybe show on an example, right now, as we speak today, what ETH is, 1,200 roughly, right? And depending where you trade it. So let's take a practical example, right? What happens if we are trying to tokenize risk when ETH is 1,200 and then it grows, let's say it's becoming 1,400 again. On February 8th, we're going to have Ethereum futures launch. So I'm sure that is going to have a certain impact to the price, right? And what happens if it goes back to, let's say, 1,000? So let's take like the 200 like risk reward opportunity with ETH. And if you can show maybe on an example and explain how it works.
Yep. And there's a lot to unpack there. I'm going to just say a couple quick bullet points because we could go on about this for hours. But one thing that's important is people do like loop BarnBridge into CDOs because I use the term tranche. I originally called them risk ramps, and like then again, like with the proof of liquidity, there's not really a good like word to describe what we're doing, but I use tranches because I thought that people knew what tranches were after the financial crisis. But if BarnBridge had existed and was widely utilized back then, there wouldn't have been a financial crisis, because I worked at a subsidiary of JP Morgan selling super illiquid debt coming out of the financial crisis, because they had to unpackage all of the packages and figure out what was in them. And it took them years, right? So I started doing this in 2012. The crisis was in 2008. And so it took them a very long time to even figure out what was on their books before they started unpacking them. Well, with crypto, you could basically see on chain exactly what was in the tranches. And also, I'm talking about, like, to start with BarnBridge, we're just doing a single income stream, like DAI to Aave. I don't know if it's more or less risky than, thousands of mortgages all around the country or whatever. That's arguable because there's smart contract risk, and most of the yield in crypto comes from lending to traders. So that's a conversation for another day. But we're just talking about taking a single income stream. So just instead of a collateralized debt obligations for MBS, which is what blew up the system, you could just do this with like one bond, right? But you could create CDOs out of using BarnBridge. And I think that's something that people need to be aware of. On the yield side, you have the potential to like lose money, right? Like one side very well could come out net negative from where they started. And since it's crypto, people definitely need to be aware of that. On the smart alpha side, most likely neither side is going to lose all of their money in any scenario. So in your example, let's say ETH is worth $1,000 instead of 1,100, just to keep the math simple. If futures come out and they crash the price of ETH the way that they did with Bitcoin, where the CME used futures almost as like a financial weapon against Bitcoin back in 2017. I think that the CFTC chair said that like the Trump administration actually used futures to crash, like to manipulate the price of Bitcoin. Whether you believe that or not, I'm apolitical, but something happened when they launched futures. So it could very well happen when they launch ETH. And so basically what would happen in that scenario, ETH's at $1,000, it goes to 800. Well, let's go back to the $100 pool. There's negative 20% of alpha, or negative $200 of alpha. $100 pool is split, let's say, 80-20. One of the sides is, I would have to get a pen and paper out because it's later in the day now, but one of the sides is going to lose more than the other side. Now, if it goes down to the point that one of the side, like the initial, you've lost more than $50, right? Like, so you're at like a 80% loss. Well, the way that we designed the Smart Alpha product was so that, similar to what I talked about a second ago, where there's a waterfall, which is what it's called in traditional finance, you basically have a first loss and a last loss. If there was more money lost, then the pool begins to pay its own principal down into the senior side, right? So if that becomes like essentially lopsided, then the junior pool blows up. And that's something that's important to know, is that in finance, it is a zero-sum game. And I think that, like, politically speaking, that's why a lot of people hate Wall Street, is because they don't actually create anything. And so there is a winner and loser in every single trade. That was one of the reasons I got into software and left Wall Street, is I didn't like the predatory aspects of selling something that every time I won, someone else lost. But with that said, with a huge asterisk, how you manage that, most pools are most likely not going to blow up. So if you lose 20%, most likely what's going to happen is the less risky side loses 4%, the more risky side loses 16% of it, right? Like, so you do subsidize the losses of the other side in the same way that if it goes up, you subsidize the gains, right? But the Smart Alpha product most likely won't blow up unless there's a huge degradation in value, which can happen in crypto.
So again, as much as I really want to talk about it, like on a theoretical level, like, and I'm happy to talk about it hours, and I'm sure we're going to find really interesting topics.
Yeah.
But I want to also ask you, like, is there a chance maybe you can share your screen and show practically, like, how would one get into, like, like 3 pools, or at least one of the pools, and explain what are the potential risks in the first pool? As you mentioned, there's less chances to lose, like, your money, right? Just because it's pegged to a stable coin before, right?
Yep.
And what are the rewards, like, what is the term, like, the epoch. So I think that would be very useful for people to see this practicality. Because I've been criticized that, 2 talking heads, like, it's not the most exceptional, like, what people enjoy. They want to see how you can get into
How it works. Well, let me just real quick before we do this. So BarnBridge, what I've described up to this point is not live. That goes live in, I want to say, like 3 weeks. Our DAO launches, and then in mid-February, these actual products I'm describing to you launch. Everything that BarnBridge has been doing up to this point is yield farming, which is very different. So, I mean, not really. Let me describe. So there's 2 types of yield farming. There's one where you just put money into Aave. Aave goes and lends it out to traders. That is considered like yield farming. And so you're basically like getting yield off of Aave, right? There's also yield farming, which are like token distribution. So like Aave has a token that governs its protocol. Like Compound has a token that governs its protocol. And so with BarnBridge, we launched our DAO that was essentially a launch DAO that just manages the original amount of money that we raised. We're launching our real DAO, which the bond token governs. And we started distributing that token back in like October, I think. And it was important to me for a lot of reasons, like mainly politically, but also like right from a regulation perspective, that we distributed the tokens under current guidance in case something was to change, right? So like we wanted to get governance out and distributed into the ecosystem so that a community around the world can manage how this protocol is dictated, because I personally believe that this protocol has the ability to like fundamentally change finance, because you're taking aspects of distributed ledger technology that amplify risk management in a way that you can't do with traditional risk management. So I want to put a huge asterisk on here for everybody to know that what is currently going on with BarnBridge is not the products I've described. It's basically people are putting up capital to farm governance of this future protocol that I'm talking about. And a long time ago, when we launched in October, that was a lot further away. Now, by the time that people even listen to this video, it's going to be a couple weeks away.
No, it's important. We're going to actually touch upon this question about the DAO, about your token, or why there's only 10 million of them, how it's going to be like autonomous, what's like, that means basically for someone who's not familiar with the DAO concept, like, is basically what's going to happen, and it's going to be, completely decentralized. There's not going to be owners. So the governance of the entire project, it will be like, this short, like, the acronym of decentralized autonomous organizations. There will be no that. It will be controlled a little bit by the, like, a lot by the founders, advisors, and early seeders. Yes, just because they will have more tokens to pledge and to vote. But essentially, it will not belong to them, right? And there will be. What I liked about what you announced is a fair vesting schedule, which I think is very important to eliminate, like, those major cliffs when the basically the pump and dump, ideas, which a lot of projects introduced in 2017 and early 2018. And again, I don't want to miss this point. I think it's very important. When I prepared for the interview, I actually they came out like one of the major positive aspects, your transparency and your desire to actually not just talk about it, but actually try to implement everything to make sure that the community will have enough interest and incentive to make it fair, to make it as a real DAO, not just like mimicking the DAO. So we're definitely going to talk about it. But again, I The community
Let's-
incentives you created are amazing, you know. So I just want to also show people how it works, at least at the current version. So I'm actually excited to do it the second interview, if you would be open to, like, you know, once you launch. But I know that for now, right now, as we speak, there are people who already earned the bonds, and I'm talking about the
You can make real
BarnBridge.
money on BarnBridge right now, and that's why people.
Yeah.
I mean, I think that people were excited because of the idea, because even before we had a token that had found market price, there was, I think, like 400, maybe 200 and something $1 million in the pool, which the most money that had ever been going after a non-price token in a pool before was like $11 million. So we didn't expect like to have this degree of capital in the pools, but now there's a reason that that there's money in these pools, and it's because of the money that you can make off of it. And then I think amplified by the fact that people obviously believed in the idea enough to go after it in the first place. But it says my screen sharing's disabled.
Oh, so, okay. Let me again. I've just enabled it. Yeah.
Okay. Yeah.
So right now, by the way, the total value locked as we speak is 239 million. Right. So this is impressive.
Yeah, it got up to.
Yeah.
A lot at one point, like 600 million. I can explain a few things just in case anybody's wondering. So like 10 million tokens is an arbitrary number. I wanted it to be 20 million so I could say it was $1 million less than Bitcoin. We decided 10 million because it makes the math easy, right? Like $20, 10 million, the thing's worth $209 million. We could have done it at $1 million, right? But 10 million, I like the token prices being like lower for the same reason that like stocks split in price, but I wanted it to be more what do you call it, like scarce than Bitcoin, just to do it. But we turned the mint function off, so there can't ever actually be any more bond tokens made. We can't, like, we would have to create a new token. So that's like the boring answer that that everybody gets for why we picked 10 million. In terms of what BarnBridge is currently, it is a pool of $240 million that is locked into our smart contracts. This is a user interface that represents the backend. So like in crypto, there's a protocol and then there's a user interface. This is a React user interface that plugs into our protocol. Like BarnBridge.com, technically, like I own that until a DAO can actually have representation of a domain name. But what powers everything that's on the screen is powered by a protocol that the DAO will control. So with BarnBridge, there never was a company. We never started a business. It started out as a decentralized autonomous organization, which really is just tokenized representation that you can use to vote on how money behaves inside of a bigger pool. And so that the bond token will be representative of how the money, not the $240 million, because that is like people who have staked it, but there will be fees on the platform, right? And so like how things are distributed, like whether they're given to coders to build new things, that's what the bond token represents, right? It basically governs everything on the protocol and what happens with like fee accrual of that. So right now there's $240 million stake that is trying to earn out of these three pools. Does that make sense so far?
Yeah. So the only thing what I want to also maybe mention that you've raised about $1 million so far, like as I just to build everything. So when you're saying there is no company like, you know, formed, right? So and I know you have prominent investors like coming from Fourth Revolution Capital, Verify, Centrality, like, you know, folks from DARMA Capital. I know some people put like their personal capital, some people they invested from a firm. So they actually got the bond token. Or because there's no equity, right? That's
yeah. So that money went into what was called the Launch DAO, and so the Launch DAO controls that $1 million as along with all of the bond tokens right now. Once we launch the BarnBridge DAO, everything will just get transferred over, and the Launch DAO will. I mean, it can't cease to exist. It's on Ethereum forever, but it's not going to be like used for anything anymore. And so the way that that's governed by this thing called the BB vote token, which like isn't, I mean, it's just going to be a cool token of my like early involvement. I mean, it's going to just kind of become like an NFT. So there's like 100 BB vote tokens, and that just manages how we managed our money, right? Like, I mean, some of that was my money. Like me and my co-founder, we raised 900K because me and my co-founder put like 100K into it. And that was one of the reasons the seed valuation was so low, is we just honored the same price that we went in at. And so we've actually raised more than that. I don't even know if the community knows this, but like we do general treasury management, and I've done OTC deals. So I've probably raised another like 1.5 million, because we had to expand the team when like the pools were hitting like $250 million. Like we didn't expect this degree of money in these pools. So I need like more programmers for everything from security to expansion. I mean, it exceeded our wildest dreams. So I raised another like 1.4 million. That went into a multi-sig. That money is going to be managed by either the multi-sig, or it would be managed by the DAO. But any like money that is accrued through BarnBridge, the DAO, or the protocol, that's going to go, and all of the treasury tokens that represent like, you know, all of the future rewards. There's going to be a large amount of like treasury tokens inside of that DAO. Well, the community is going to vote on what happens to that. And one thing to your point earlier, not to ramble on, but this is pretty important. I was like pretty adamantly against the way that, like, I'm a decentralization maximalist, and so is my team. Like, we were all early stage ConsenSys, and like I saw like projects try to control everything about their protocols. And like, if I wanted to do that, I'd just start a company. Like, I've started companies before. So we wanted the community to essentially run the protocol from day one. So like the day that BarnBridge launches, the community actually will be in control of the protocol. Like, you are right that we will have a very large chunk where it would be close to 50%. So it would be very, like, you couldn't like rob the treasury, because you need like a 68% threshold in order to get a crazy vote passed. But we can't either, is the easiest way to put it. So like the community could overrun us from the beginning, and all of the money in bond tokens that is being distributed, most of those are in smart contracts, and they're already pre-programmed to be distributed. We can't actually get them out. Like, so it's getting more and more and more distributed every day. So when it launches, it'll probably be like 60-40 in favor of the community. Long term, only 22%, maybe 23%. After I did some of the treasury management, the fund runway, I'd have to like redo the math. I don't know off the top of my head. But the long term, like, let's say 23% was controlled by insiders. And that, like, by May 2020, I think all the tokens will have been 2022, all the tokens will be distributed. So like from day one, when we launch the DAO, it'll be community governed, and it will become increasingly community governed every single week.
Perfect. No, I think that's a very important comment. And again, that's one of the reasons why I was excited to have this interview and to actually like spread more, like, you know, more light to this product, because I want to make sure people really understand that you have the best incentives, like, you know, to make it more distributed. So without further ado, let's go to the pools, you know, like, so help us to understand, like, you know, what are the potential rewards for each pool? What are the risks? You know, let's start with the first pool.
Yep. And I think in true risk management fashion, we were like the first group that launched a stablecoin yield farm. I mean, they may have been one before us, but we open source these contracts. So if someone else wants to actually utilize this, they can. So a lot of the yield farms were essentially like they're more risky because they're like an ETH DAI pool, which means you have to have like ETH exposure to join it, and like ETH can fluctuate in value, so you can lose money in those pools. I wanted there to be a way that you could just earn money that you didn't have the exposure to a more volatile asset. The other reason that we did this is because most of the money that is earned in crypto is from stable coins, meaning like the highest yields are normally stable coin yields. So those are going to be what like our first pools are built with, is like a DAI pool running into like Aave, USDC running into Compound, SUSD, which is synthetic stablecoin. But these are all like supposed to be worth $1, right? Like they don't, I mean, they fluctuate a little bit, but they're not supposed to be worth like 50 cents, where like ETH could be worth $500 tomorrow if something crazy happened.
Yeah. So they're pegged 1-to-1 to dollar, right? Yep. If I may ask you, specify, like, what you mentioned before, because I think it's important for the future development of the project. When you mentioned that you basically, like, it's open source, so essentially what someone can do if they watch this interview, they can literally white label like the pool and like use it and help other people to get into and get the additional yield by just changing, but even doing it under their brand. Is it possible?
Well, they could use the pool to create a new token. Like, so they could, these are called like yield farming contracts. So like if they wanted to create like a pond token, then they could use the same distribution mechanism. The reason that's important is just because like, like ours are audited, and like they had like $500 million in value at one point and didn't get hacked. So like they're safe. I mean, like it's the biggest bug bounty in the history of crypto, and it survived. So like, I don't think these are getting, I mean, knock on wood, I don't think this contract is getting hacked at this point. So like, it's just open source, meaning if someone else wants to use our contracts to distribute a token, they're more than welcome to. Does that make sense?
Yeah, sure. No, I just wanted to clarify that, like, how people actually can use your contract. Okay, please, let's move on. Why 32,000 bonds as a reward?
I think we had like a very well thought out reason a long time ago for what that was, and I can't tell you for the life of me.
It's fine.
Why we picked that number in retrospect. It was, what's 25 times? Oh, you know why? Is because 25 times 32. Is that just like the one number Google doesn't? Okay, yeah. So 8. So 8. We basically are giving out 8% of our entire token supply to yield farming. The other 60% that is going to the community through like farming efforts are going to be like on the actual product. So like 20% will be for like our smart yield product. We'll probably have 20% for smart alpha. And then 20% is just like variable like, liquidity rewards. The community is going to vote on all those numbers. So like, I mean, as soon as we launch, like it's going to kind of be up to the community to decide how we structure some of this. But yeah, so 8% of our token supply went out through this mechanism. And so we thought it was going to take about 25 weeks to get everything built fully. And so we wanted to, in case there was like something bad happened or it took us like twice the amount of time as what we expected.
So it's almost like mitigating the risk of potential, like, deviation in the milestones that you promised to the community, right?
Yeah, just in case so we thought it was going to take about this long to build, and we said, all right, if it takes twice as long, that's like half a year, 6 months. So that was why we did it. So 8% is going to the community, and that just happened to turn out to be 32,000. So if you go onto our Discord, we have a bot on Discord, which is important for people to know, that helps you calculate the returns. You also can go on CoinGecko and just like look at the farms. So if you look at like the yield farms on CoinGecko, you can see the size of the farms and their return. So like SushiSwap and Aave are larger than ours, but we have $220 million. This is the first pool at 15.56%. And then if you just scroll down, there's going to be other ones. The other ones get like a lot more juicy. But if you look at, if you join our Discord, we just have bots built into it that show some of these. Honestly, I don't really know what's going on. I don't know how to get it to appear on Discord. Maybe it's in general. Okay, yeah. So in here, we have an APR bot that'll show like 15%. In that first pool, there's 175% in the second pool, 95% in the
well, I'm sorry, but the difference is quite substantial. So let's maybe like explain the reason behind it. Because again, I think I clearly understand what's the difference. But for people who are get excited about 175%, we have to also disclose the potential risks. What's behind it.
Yeah, I actually wrote an article for everyone that was actually somewhat encouraging people not to go after that 105% for a reason. So like if you go into our Medium, there's an article called Yield Farming and the Risks Involved. This is actually a pretty good overview for like all of crypto, because I can't talk about like our own token price and like whether it's going to fluctuate in value, because it is like a valueless governance token. Like the value that has been put on it by the community and other people in the community. I've never like said it's worth $1. So we didn't even set up the original liquidity pools like on Uniswap. Like the community was incentivized to set those up. So like I can't like come out and say like whether I think like a pool is necessarily more or less risky, because like if I said it wasn't risky at all, like I'm saying the price of the token is going to go up. So just from like a perspective of generally talking about crypto, there was a lot of money staked in the pool. There was a lot of like irrational exuberance very early on in BarnBridge. And I tried to write like a very comprehensive overview on risk in crypto for people that just don't like get it yet. And so this long article at least gives like an overview of kind of the difference between some of these pools. We've since written that article, created a bond for bond staking pool, which I'll get to in a second. But this first pool is very low risk, meaning you, the easiest way to think about it is we are giving the token away in this pool by having someone prove that they have capital. And the reason for that is if like someone is really technically savvy listening to this, like Bitcoin distributes its tokens through a mining process called proof of work that uses cryptographic algorithms to essentially distribute the coin, right? That is how Bitcoin is created and distributed. Well, the cryptographic algorithms represent like the security of the network, and like as important in my opinion as cryptographic complexity would be for a layer 0 solution like Ethereum and Bitcoin, meaning they're very difficult to hack. They are cryptographically secure. DeFi, its lifeblood isn't necessarily in its security, which it is, but our security of like this contract here that I have highlighted, this is safe so long as Ethereum is safe and so long as like the contract is written well. But like if it was going to get hacked, it's not like Ethereum would need to get hacked, or like there would need to be a flaw in this particular pool, is the easiest way to put it. So DeFi like has its own security risks, but they're not like cryptographic security risks, like because those are upheld at the Ethereum level, right? DeFi's lifeblood, assuming that you do have safe contracts, its lifeblood is liquidity. So there needs to be like, in order for us to tokenize all of these risks, which I'll show you in a second, like it gets expensive if you're dealing with like small amounts of money, right? So like it's really hard to tranche out like, 50 different positions in $100 pool. It's a lot easier to do 2 positions in $1 million pool. So
and
like,
especially because of the gas fees, right? Essentially,
even without gas fees, there's like liquidity issues. So like if you only have $1 million to play with and you slice it a million different ways, Well, you've got to go find a buyer for 1 million positions now, right? Like, so like liquidity will always be, even if gas fees go to nothing, like because someone figures layer 2 out really well, liquidity for all of finance is the lifeblood of it. And even in traditional finance, this is the same as gas fees because the legal fees, there's only so many different ways you want to create a structured product with $1 million. But without getting on too much of a tangent, what the point of this first pool is we are distributing the token via a proof of capital mechanism. So we want to prove to people that have capital that they can put their money here, and we don't do anything with it. We don't like redeploy it like on Yearn, or like a lot of these pools will redeploy to essentially like an Aave and then like move it around. We're not actually doing that. The money's just parked there and you get your capital back out along with your bond tokens at the end of the first epoch. So I'll show you how this works. And for people like thinking like, okay, well, you're just giving these away. Well, that's how we had to distribute the token for the first time, right? And like to prove to people that have large liquidity positions we didn't expect $240 million to be in there, or we probably would have done more than 32,000 coins. But the easiest way to think about this is we're distributing the token to people that we want as much capital locked in here as possible, because the point of the protocol is to tokenize risk for as much money as possible so that the protocol accrues fees. So hopefully that explains what the point of this pool is. But this is a very non-risky pool because you essentially have, you can just stake US dollars in there, get your US dollars back out at the end, so long as the contract isn't hacked. And then you also have your bond on top of that. So there's $220 million going after 32,000. So if you stake $1 million, you're going to own 15% of that's what, like $150,000. So if those numbers stay the same and you hold it in there, $1 million of USDC in there for a year, you're going to end up with $150,000 worth of the bond token.
And let's discuss. This is exciting, and also you can pledge your bond token to other pools, right? And increase the return potentially.
Yeah. So that 15% doesn't include compounding. So let me explain that. So there's two different pools you can put. Once you get your bond token, there's new pools that you can essentially put it into. This is the riskiest pool. It's the USDC bond uni LP pool.
The one that is 175% right now.
We'll go over that one last. Just to make this easy. Honestly, these should be switched because they do represent like the amount of risk. So like $12 million is locked in this pool. There's 5 million, close to 6 million in this pool. I obviously have like a large amount in this pool, which that's my proceeds from farming up to this point. My main bond balance isn't in this pool because this pool was actually created for smaller players. Because essentially we had a whale problem that like when this got to $220 million, the point, we need the token to be distributed and decentralized, and it wasn't being decentralized because very, very large players were putting massive amounts of capital in here. And so there wasn't a way for like the smaller players to like signal or have incentive to like hold bond for a longer period of time. So it was kind of like if you don't have $10 million of USDC, you're not getting a sizable position of bond. So what they were doing is they were going and buying it on the open market and putting more capital at risk. And so we created this pool to essentially just be able to roll over your earnings and make a certain amount. It needed to be a lower amount than this pool because this pool represents the liquidity. But like basically, I don't have my entire stack of bond in here. I shouldn't have shown this with like one of my larger wallets, but I don't have the larger stack of bond in there because we basically want to give access to this pool to people that can like signal going long. And if I take my like 4% of the network that I own, and I just go stack it all in here, then I'm going to own like an unfair amount. And like, we didn't create this for us, but I have made money trading in and out. And like, I use this wallet. So I have like 150K in there. Right.
So just to clarify what you just said. So if someone is getting like, let's imagine like, I mean, I don't think a lot of people who are watching this video will own like millions of dollars and will immediately put there, but let's imagine something like $10,000, $100,000 that they realistically might be interested to participate, right? Again, it's not an advice to do that immediately, but just a hypothetical situation, right? So can they literally, with their, let's say, $100,000 worth of USDC, go directly into the pool number 2 or pool number 3?
Yeah, but they would have to buy the bond token off of Uniswap, and I really don't recommend doing that. Like, that wasn't the point of why we created this. Like, what they would do is they put $100,000 into if you're going the low risk route, if you know what you're doing, then you can worry about this pool 3. But the point of this was that you could put $100,000 into this pool, prove capital. We're hoping that when the project actually launches, the protocol launches, a lot of this $220 million will roll into usage of the actual platform. And we have more incentives like lined up for that will actually be higher than what the yield farming pool was. So long story short is that you can essentially put the $100,000 in here at 15% at 150,000. What would that be? 15,000?
50,000, yeah.
Per year. Well, that means that like each week you're going to like, I don't, just simple math, like it's like 20 bond per week or something like that.
Yeah.
So if you're earning 20 bond per week, then what you can do is you can roll it over into this pool and then make like 95% annual returns, right? So if you just keep that $100,000 in the original pool, then you have 3 options. You can either sell and put it back into pool 1. And that's what some people do, is they just try to make as much USDC as possible. That's not why we designed this, but to each their own. If that's the way that you want to do it, that's fine. We can't stop you. If you want to like signal that like you want to own this long term and you want like more of it, then you can essentially put it into this pool. The other option is you could sell half of it for USDC, and you can go into this pool, which this is the last pool I'll talk about. But so you can either sell all of it, you can put it all into pool 3, or you can sell half of it and go into pool 2. The issue with pool 2 is it is by far the most risky. So pool 1 and this bond for bond staking, which is the pool 3, or we call it the HODL pool, those all use the same contracts, which means you get your principal back. So bond could go down in value, meaning you have a permanent loss, like meaning you put it in at $20, it goes down to $10. Doesn't matter how much you farmed in there, you probably still lost money. But that you still get your actual principal back, meaning like you put 10 bond in there, you're getting 10 bond back out, and additionally whatever you've earned, right? Well, that is not true about pool 3. Pool 3 is, and I would recommend you read this article. Pool 3 is it is not even bonds technology that you're plugging the money into at this point. It is, however, extremely safe. It's not going to get hacked. It's in Uniswap, which has had multiple billions of dollars of pools, right? If Uniswap was going to get hacked, they would have already. Kind of similar to pool 1. There's been over $1 billion staked in pool 1 over the course of like this journey. But there's probably $1 billion on Uniswap staked like right now, not like ongoing. But basically what Uniswap is it's an automated market maker, which means that if I was going to show someone how this worked, I actually sold like 25 bond before the call because I wanted to show everybody. And so if anybody in the community is watching and want to know why I sold 25 of my bond, it was because I didn't have enough ETH to cover the or USDC. And so long story short is, if I wanted to buy bond with the USDC right now, I can come in here and I have like a price and a price impact. What this third pool represents is it's a liquidity pool that ensures like there is decent liquidity for the bond out in the market. So there's $12 million, which is why like if I trade, you know, $25 worth, it's only going to affect the price by that much. If I sell my whole stack, I'm going to crash the price by like 8%. I don't want to do.
We don't want to do that. No.
Let me get completely off the screen just to prevent that from happening. But okay, but the way that that's managed is by a pool. Okay, and so if you want to actually join the pool of money, you would come in here and do it. And I'm actually not going to show anybody how to do it, because if you want to figure that out, do it yourself. It's extremely risky. I don't recommend that you do it. I have money in there and I have a lot more money on another account in there, but like, I know what I'm doing. I'm a professional degen. Like I'm like a professional crypto person. So if you don't know what any of this stuff is, if you don't know what an automated market maker is, don't put money here. And the reason is because if the, what I could end up with is if the bond price crashes, I'm going to end up, so I put 10,000 when I guess when I originally put money in here, I probably put 20 grand in here. I did. Yeah. So, and bond has gone up since then. So the pool value rose, which means that when I pull it out, I'm probably going to have less bond than what I started with and more USDC. If bond like triples in value, like the pool has to get the USDC somewhere, and it gets it from people trading back and forth against this pool, and it automatically like creates a market making mechanism. Now, if bond's price crashes down to $1, there's not going to be enough USDC to represent that. And it was traded against it. So I'm going to end up with like a whole bunch of bond, but like not any amount of my original $10,000 that I invested. And like, that's the part that gets risky, is that I want to own a lot of bond because I created this and I want to have percentage voting value in the network. I don't really care about USDC other than that's what I pay my like rent. And so I care about it for like life and food and the reasons that people care about the US dollar. However, like I don't want to be massively over leveraged to pool pool 2, because if bond skyrockets in value and I've built this like multi-billion-dollar value, like I'll never be able to buy back into that like position of being able to vote on what I can do on the network. So it kind of comes down to your like cost basis, what's valuable to you, what do you want to do with it? And it can fluctuate outside of your control in that pool, where you could end up with way more voting power in the network than you wanted, or way more dollars, or way less of either one. So
let's maybe simplify, because I know like you've provided like a very deep risk management perspective, which is important. I think like people should know what's behind it and why it is risky. But I want to also understand, like, so for the people who want to try this out, like, that's under their discretion. So what is a how long does it take to lock your your bond token here? Like, so you get rewards in the first pool. It's easy. You just lock it out like your weekly. And when can you?
They're all the same, actually.
They're all the same, right?
That's a great question. And there is no lock at all. You can pull your money out at any point. That won't be the exact same for the actual products. We'll probably, just running back to what y'all were thinking about earlier, the senior side will probably be guaranteed by the junior side, which means like $100 is in there. If it's 5% interest, the junior side will have $5 locked. So not like the whole amount, but the way we did that was clever. But locking in crypto sucks. Nobody wants to have their money, like their whole principal, locked up for a long period of time. So you're not like penalized for pulling out early either, like YFI. You just don't get a reward. So you can pull it out at any point. So our epochs start on, if you're in EST like New York, it's Sunday night at like 7 p.m., but it's midnight Monday UTC time, which is blockchain time. So every single Monday at midnight, which just happens to be my like 7 p.m. on Sunday, that's the start of the next epoch. And so if you put $100,000 into this first pool here, you have to keep it in for the entire week to earn your reward. And it's time weighted. So if you put it in on Wednesday, you have to hold it from Wednesday up through Monday, right? Now, this is really important. If you pull your money out and you put it back in, it's treated as a new deposit. So you have to hold it through finality of the epoch in order to earn anything, or you don't earn a dime.
So what is important? So once you imagine a scenario, so you waited till the epoch, like let's imagine a perfect scenario. And Sunday, 7 p.m. EST, because I'm also in New York, it's easier for me to think in EST. So you've put it out. Then in 1 week, you decide to pull up the money. Like, so you earned what, like, let's say 20 bond, right? And then so.
Okay,
that's all.
This is how this will work. So, because I haven't even claimed all of mine.
But it's just to clarify my question. So before you claim, the money they're not in your account, right? So but you can they automatically accrue. So if you miss, like in SNX, right? If you miss, like, to claim your rewards, so you will not get them. Like, so this, in your case, it's still like, it shows that a current reward, you can claim them at any time.
Yeah, so they stay in there forever. And this is important that even if I pulled all this money out, this 2.38 was earned by me. It never goes away. Mm-hmm. And we can't even get it out of the contract. So like, you can pull, once your reward has been earned, you still have to claim it in order to get it, but it stays in there forever. The only person that can pull it out is your wallet that represents it. And you don't have to keep the money in here in order to claim it. So like, if you say that you've got $100,000 in here and you see another opportunity that you want to go after, you can pull the money out, go after that opportunity, but maybe you don't want to claim it because gas prices are too high right now. You can come back and claim it later when gas prices aren't high, right? So once you've stayed in through the finality of an epoch, that is your reward. It is the wallet that you farmed it with reward. I just assumed that was your question.
No, I think it seems like a very basic question, but I want to make sure people understand that, like, because, it sounds exciting and
claim every single week. I don't know why they did it that way. I think that it's important that you have to claim your reward because it requires the user to take an action. It's not like an automatic dividend. You don't just earn money from holding bond. You have to perform an action and do something. But I kind of wish that synthetics, personally, I used to have a lot more money in synthetics before I started BarnBridge. But I didn't like that aspect of synthetics, and that's why we didn't do it, because I wish I could save my rewards up in the account, because sometimes in some of my wallets for synthetics, the reward is lower than what the gas fee is. That's why I didn't claim that, right? Like, I bet you if I try to claim this, it's going to be more than it'll be like $20, and I'm like giving up half my, principal. So I'll just let it save up in there and then I'll claim it later. But with synthetics in particular, sometimes I just don't even claim my reward because the gas price is like higher than what the reward is, and what the hell's the point? So that was why I didn't do it the same way, or why we didn't. I don't think it's important whether it accrues or auto accrues, but it is important that you have to claim it. That for people watching, that if someone's starting a protocol, for a lot of reasons, especially from a regulatory perspective and whether it's a security or not, the user needs to perform actions and do work on the network in order to earn a reward. They should not be getting like automatic rewards for things.
Yeah, no, I agree with you. It is important, although I prefer your model towards like SNX, because synthetics, like it's a bit like, it's almost like a job that you have to go and claim it, even though it's like, well, like two button clicks. It's not like a rocket science, but it's still like, if you miss it, like you miss it. So it's kind of like this. It's kind of annoying a little bit. Like, so I actually appreciate the fact that in your model, you can just claim it later, like, which is completely like, to me, sensible approach.
And to be fair to synthetics, the founder of synthetics invested in BarnBridge, and he's been like, I would say out of even like out of everyone involved in crypto, Kane's helped the most with BarnBridge. Like even from the very early, like BarnBridge wouldn't exist without Kane. So like he invented yield farming a year before we launched this. So like it's easy for us to Monday morning quarterback on what he would have done differently. I would say that like when we launched BarnBridge, like I improved on a lot of people's models. Like I think I improved on YFI's model of fair distribution. That I didn't think it was a good idea that the founders didn't get anything because like, you know, Andre's like left and he's gone and done other things. Like the biggest risk to YFI to me was that there was no founder share. And like a lot of the devs don't have the incentive long-term. Now YFI is a great project. I don't think that there's a huge risk there. I don't want to like plant seeds of doubt into the community. I mean, they did a spectacular job in the same way that Synthetics has. I thought that it was better, not even from a selfish reason, but because of incentives that the team actually retained like a certain percent. So the team members took like 12% of the network as like a fee to get everything up and running. And so like I have a long-term incentive to be a part of this. And I would be pretty pissed if I wasn't, because if that $220 million was there, I wouldn't have been able to compete with that. So I would have had two options. I either had to front run it and not tell anybody, which would have pissed everybody off, or I would literally have no reason to be on this call because like I, you know, wouldn't have any money in the thing.
You'll be an altruist that just contributes to
But even Andre wasn't that much. I mean, like the reason why if I worked the way that it did is because there was very low amount of money that was originally staking. And yeah, they let everybody know about it, but like more and more people found out about it. But the original people, like the founders have, I mean, I would say I probably have less bond than like Andre does of YFI in terms of a network percentage. And I don't know that. And I don't even know Andre. I think he's like a genius, but long story short is they did have, but I kind of looked at the way that it rolled out and I was like, I think that could be improved upon. And I did the same thing with what Synthetics did. So it's a lot easier to come second and say, this is how you win a Super Bowl than like the first person that had to win it.
Yeah, no, of course. I mean, we don't criticize. I'm just also voicing out like my own preference, you know, that I just like what you did. And then of course it's, you improve things. That's why you create new products, you know, like, and it's hard to go back, especially with any DAO project. You cannot go back and just like, you know, fix it like, you know, easily. So that's already off your hands. So yeah. So I think, do you think we can show something more here, or we can just just roll out? I think we can just stop. Yeah.
For the sake of time, if someone wants to know, like, this is pretty easy to use, and I would just recommend that they join our Discord. But like, if they know how to get like USDC, get it into a MetaMask wallet, you've got your MetaMask wallet attached, and then you want to come here and stake it, you just enable the token. Once it's enabled, you click down, you hit max, and you deposit. And then you come back at the end of the week and you hit claim.
Yeah.
But for keeping this simple for everybody, someone can now come on here and know what these three pools are. They kind of know what they represent. I think we can stop sharing, and then we're super active in our community. So if you like have problems trying to figure this out, like just let us know. I'm probably not going to teach someone how to join pool 2 if they're what we call normies, which is people that aren't that familiar with crypto. And it's not because I want that juicy yield for myself. It's because I think it's risky, and I don't think people should be in there unless they know what they're doing. No. Because an automated market maker doesn't mean that you shouldn't know what you're doing in order to become a liquidity provider for it. Because when you become an LP for an automated market maker, you are becoming a market maker. And that's a very high paying role on Wall Street. And there's a reason is like those people are smart. So there's professional people that are a lot better than you that will eat your lunch if you try to compete on something you don't know what you're doing.
Yeah, I think it's a very fair and valid point, because, you know, you have to educate yourself and you have to bear as much risk as you can, you know, as you can handle, right? It's almost like think about it like a margin call. If you do like 100x margin, like, so, I mean, any movement can kill your position, and then you're going to have a margin call, and it's very unpleasant. And actually, I've been in this situation, so I know how painful it is. You have sleepless night, and I don't I don't suggest anyone to be in this situation. So yeah, I actually I support your precaution. So just to end up on a positive note and also kind of more refreshing on a personal level, if I may. So Tyler, I know that a lot of folks who are in crypto, they have, besides the economical wit and the financial awareness, I think there's a lot of I would say philosophical and holistic awareness, and my podcast is also holistic investments, not only because it's just like a fancy word, because it means something to me. So on a philosophical level, I want to ask you, what's the meaning in life to you, and why do you even do this, like on a personal level?
I like to, I mean, people have asked me this because my wife especially, she's like, why do you keep doing all this stuff when you don't ever like buy anything for yourself? Like, so I'm definitely not materialistic. I mean, I have a nice life. I was early into Ethereum. And so I sold a lot when it hit 800 the first time, and, bought myself a nice life, like not like buku crazy rich to like where I never had to work again, but at least where I had like a buffer. Right. And so I think that was like the first thing, was like having like a level of security. If you're thinking about like Maslow's like hierarchy, like knowing that like I could go a couple months without like having to, like, when I wasn't going to miss a payment on something like that. Obviously, like if you're not in that position in life, I would recommend trying to get there as fast as possible by saving money and taking on as little debt as possible. And that was always pretty important to me, that I did take on debt. By the time that I started BarnBridge, though, like I actually asked Kane to steal the idea originally, because I was running another company. Like it was doing good revenue. I had 15 employees. I didn't really want to start BarnBridge other than like I wanted to use it. So I had written this white paper. And back when I originally wrote the white paper, ConsenSys was raising money. They had a lot of capital. A lot of the really good programming talent was at ConsenSys in the industry. When they didn't get that loan from JP Morgan, it really actually helped the industry, I think, because they got rid of a lot of people. And so I wouldn't have been able to build the team that I have if I had to try to compete with ConsenSys on salaries. So long story short, when BarnBridge, like when I actually decided to build it, like I had other things. So I didn't build it for the money. I built it because I wanted to use it. But I think like, I don't know what the meaning of life is or what the original question is, but the reason that I think the essence of what you're getting to is why did I build this, or like what keeps me going on this? And it's 100% that I just like to make things. And I've been doing it since I was like 19. I started my first company. Like I don't think that any amount of money that ever comes to me will do anything other than just provide me freedom to like build more things. And I think crypto is awesome. Like I really think it's cool. From the second that I realized you could write if-then statements into money and it was permissionless, and it struck like I want to be a professional and have like a real job side of me, like that I saw the opportunity that this could provide a way to like pay bills and like live. So like the Wall Street side. And then on the other side of the equation, though, it definitely struck like the anarchist chord in me of just like, I make, I don't know, like the rebel side of like, yeah, we're doing this, but like, screw the man. And like the idea of like permissionless networks. I think where crypto ends is obviously going to be that in the middle of all of those, and we'll create really cool technologies that empower people around the world and all of that good stuff. But I mean, honestly, I just built it because I think it's cool. I thought what Synthetics was doing was cool. I wanted to use BarnBridge to move in and out of risk positions back in August when I thought DeFi was getting pretty hot. I wanted to move into lower risk positions in DeFi. BarnBridge didn't exist. I had written the white paper and I was just one of those things. Like I made all this money trading Synthetics. I want to manage that risk now. Nobody else has built this thing. I thought someone would have by now. And so I decided to build it. But after BarnBridge, I'll probably keep building stuff until I die, unless I run out of money. Hopefully they're successful.
So maybe some big announcements, that you can provide. Maybe when you're listing and some of the major exchanges, I don't know, maybe on Coinbase and all. So do you have some kind of announcement?
That one, like, obviously, if we were listing on Coinbase, they're not going to let us talk about that. We're launching. On our Twitter right now, there's a pinned message that has a whole bunch of announcements. So like everything that I've described to you that I said it's not out yet, that's just because we haven't released it. I mean, it's all been built since December, but we're getting audits. When you're dealing with hundreds of millions of dollars, we had to spend a couple $100,000 of audits of third, fourth, fifth, sixth sets of eyes to look at it. So the code is getting shipped starting in 3 weeks. And so like I've personally like used if I could show all of the UI, the problem with BarnBridge is it's become successful. So like if I show people stuff, they're going to steal it. So I'm really, really, really excited that we're about to launch this thing that I've been talking about on this whole call. And it's something that I literally have like conceptualized almost 2 years ago on the day, as of the day that it launched. It'll be like 2 years later. And so it's been a journey. And so that's like the exciting side is we're launching the DAO, we're launching the Smart Yield. Smart Alpha will come out after that. And then fortunately, with the run up in market price, we are well capitalized to build a lot more cool shit for a very long time. And we will.
Yeah, no, really, I think what you've just described is already exciting. And I think, again, that the projects like that really revolutionize like the DeFi, and I'm excited what you guys are doing. I'm excited to use it. I wish you like even more faster development, and less bugs, like bad great audit results, and to make sure that the community grows and there will be more trust. And I hope once you launch, and it will be completely decentralized, and people will see that your incentives are like they're really fair, they're really like to help community. And that's what made me like also make this interview. And I think it was exciting. There's so many ideas. I don't know if people will be able to digest it in one shot, but maybe we'll do a second one. Really appreciate your time, Tyler. So maybe we'll do it again.
Yeah, absolutely. I enjoyed this. So it was awesome.
Thank you so much.
Yep.